Yesterday we had indicated our forecast yesterday, even though it doesn't really look like much here, was that the market would, in fact, our forecast actually was on April 1st, we said if they closed above 45.03, which they did, that then they would rally to 45.77 to 45.80, and they would do that into April 4th. And yesterday was April 4th, and the high was 45.80. So we had a really beautiful, kind of a grinding, slow day up. The start of the day was faster, but then later they just continued just to grind up, and they topped out at yesterday's high was 45.80. So now the market today has, this is the reaction off of that completion. They did spike to slight new high today, 45.8875, and they've sold off. Now, I can't give you the whole thing that we gave out in our room today, but I do want to inform you that if they close today, say 38 to 45.37, that's a weaker position. And we've told everybody where the market would be and on what date it would be there on the downside if we close today below 45.38 to 37. And they very easily could. As a matter of fact, it seems like they want to, but I don't like to operate off my opinion outside of, doing technical things. My opinion is just as good or bad as anybody's. There's nothing unique or special about my opinion. But, if it deals with the work of the technical side of it, then if my opinions are based on that, then I would tend to do much, much better. So anyway, so it's going to be very interesting to see how they handle today. Here's, say, a 120-minute chart of today. You can see we've been going down over the last, for the whole three 120-minute bars. They've been moving down here today with today's low at 45.3625 and so on. So the market's in a very kind of critical position with regard to an upcoming date that we have and where the market would then trade on that date if they really don't close well today. Now, they could possibly close decently today, but jump over that tomorrow or trade right through it tomorrow, and then the move would be on to the downside. So, there are a lot of people who find that they are technically proficient enough to have a series of successful indications and trades, forecasts that they convert into a trade. But where they go wrong is when what they expected, and just in a blink of an eye, the market is already too far against them for them to feel in the mood to get out. And then suddenly they've given back. The market may, like this market, may want to go down further. And if a person was stuck in a long position, he would have to sit for quite some number of points and deal with that. And so the problem is really how people manage the downside, as opposed to how well they are able to call the moves that they're calling. It's really the whole thing kind of pivots on whether or not they manage the downside very well. So there really is a period where you have to learn how to lose, as opposed to learning how to, I don't want to use the word win, but how to be successful. And that is important, of course, because you can easily give back in a single bad trade your last 3, 4, 5, 6, 7, 10 trades. So if you don't learn how to manage the position, you end up in that situation where you might very well be successful at calling the market and even executing on those calls. But then as soon as something goes, you're sort of, like a deer in the headlights, you don't make any move. And before you know it, the market's too far against you to want to get out. And then a person would say, well, then it should be bottoming here, or it should be this, or should be that. Then I'll wait. And, and then suddenly they don't bottom and they continue. So you just really have to understand that there has to be a means by which you manage your losses, whatever those means are. I'm not here to say which one is exactly the correct way to do it, but there has to be something that you do to manage those losses. If you are a person that says, listen, they always come back and I just hold until they do, like a person that holds stocks, that could go against you for quite some period of time, even months or longer. And then you're rolling out of losing positions back into losing positions on new contracts. It's probably not the best way to trade. And sometimes the market can go so far that it can really just wipe an entire account out. This is, again, why I've talked about in the past not doing the thing that you hear idiots telling you to do, this is all it is idiocy, is telling you to, you go along with one contract and then you learn how to do that. And then when you make your $1,000, then you add two contracts. Now you're into two contracts, and then you do that. And when you make another 1,000, you do this, because you're building up an inverted pyramid where all later trades are taken at larger contract sizes, and a series of losses wipes out all of the lesser number of contract trades that you took earlier on. And it keeps doing that because you keep adding to the inverted pyramid, and you end up never able to get ahead. So countering that is to learn how to trade properly with two contracts, and to stay there and trade that for quite some time. And if you need more from a trade, you work for a larger trade in terms of distance rather than stepping up the number of contracts. The reason the whole premise of stepping up contracts came into play in the first place, and this is the only reason, is because people were not aware of how to know the market was going to move further than 2 points. So all of their systems and things are built on taking 2 points out of the market, because they tried getting 10 and couldn't. They tried getting 8 or 6 or 5. And 2 is so small that it seems like they should be able to get that. But it actually gets more difficult down at those levels. When you're getting down to the atomic levels of the market and trying to trade for really small amounts, kind of like breadcrumb trading, and then managing risk. And even the way that risk is managed down there is different, because you're always risking what the trade would make, which isn't the best way to assign how much to risk. So it gets really weird. And then you're also building an inverted period. I mean, no doubt, why it's difficult for people to do well with that. Now, here we are down at 35. They're breaking these levels. We'll see what they're able to do here. But everybody that's here today, and I know many of you were in our meetings earlier today, what the indication is if we do close below certain levels here, and so on. So we'll take that on in the morning. We won't be doing overnight positions, but if they really, there's some possibility that they could get everything that's due on the date that I told you. They could get that all done even today if they really want to on the downside. But we're not too worried about that.